Good morning. It's Friday, the 20th of June, and this is Govindraj Ethiraj broadcasting and streaming from Mumbai, India's financial capital. Our top stories and themes. A cloud of caution settles over the stock markets. A big rush of initial public offers or IPOs could dampen market activity. Oil prices rise again as analysts compute war risk premium. Air India reaches out to passengers and public to announce a 15% reduction in international flights, says ill-fated aircraft and engines were in good shape. Global foreign direct investment flows fall a sharp 11%. China most hit, India also affected. Slim foldable phones is where the action is.
This is a call report with Govindraj Ethiraj.
A cloud of caution. A cloud of caution has settled over the markets now. While the caution is triggered by the Middle East tensions and what it can do to the geopolitical environment in general and oil prices in specific, the other factor that could spook Dalal Street somewhat is a supply rush of initial public offers in the coming days. Now, large IPOs usually drain out funds and divert trader interest in the short to medium term and sometimes signal peaks as well, as we've seen in the past, and more on that shortly. On Thursday, the indices were down with investors and traders grappling with multiple inputs ranging from war tensions to oil prices and renewed US tariff threats, and the latest ones being fresh tariff threats around pharmaceuticals exports from countries like India into the United States. Moreover, the US Federal Reserve is now holding interest rates unchanged at 4.25 to 4.5%, and that is also causing some concern. The Sensex fell about 82 points to close at 81,361, while the Nifty 50 was down 18 points to 24,793 in an overall choppy market day. Amongst the broader indices or markets, the Nifty Mid-Cap 100 and the Nifty Small-Cap indices were down 1.6 and about 2% each. India's IPO market is now set for its busiest period this year, with at least 4 companies planning to raise about 15,000 crore rupees or about $1.7 billion through initial public offerings next week, according to Bloomberg, which has compiled this. They include Kalpataru, Ellen Barry Industrial Gases and Globe Civil Projects, and HDB Financial Services, which is the big one. HDB is a unit of HDFC's bank with a 12,500 crore or $1.4 billion IPO targeted or likely to hit next week, which is also the largest ever by a non-bank finance company in India. Now, as is the trend with many IPOs in the last year or two, a good part of the funds that are being raised from investors will actually only give promoters exits. In the case of HDB Financial Services, the fresh issue is only of 2,500 crore rupees, and the offer for sale is for 10,000 crore rupees by parent HDFC Bank, which holds about a 94% stake according to Money Control. So about 10,000 crore rupees goes to HDFC Bank, which is effectively the promoter here, and only 2,500 crores would go into the company. The trigger for the burst of IPOs is obviously the recovery in the markets, up 12% in the benchmark NSE Nifty from its March low, and also the fact that many of these companies and many more are waiting quite eagerly on the sidelines to jump in and start raising funds. Meanwhile, the rupee continued to slip. It fell to a 3-month low as the West Asia jitters deepened the risk of sentiment amongst traders. The rupee was down about 27 paise to 86 rupees 74 paise against the dollar, the lowest level since March 17 this year, according to Bloomberg. So the factors driving the currency down, which is, by the way, across the region, is roughly the same as stock markets and thus in common with all other markets, including commodities. The fact that the United States Federal Reserve has delayed rate cuts by around 6 months is also helping the dollar, adding pressure or putting pressure on the rupee. Ship insurers raise costs. Israel and Iran's escalating conflict has significantly driven up the cost of insurance for ships sailing through the Red Sea and Persian Gulf. And according to a report from CNBC, and marine insurers are now charging 0.2% of the value of a ship for journeys into the Gulf. This is from data from insurance broker Marsh McLennan. And this is, or rather the figure is up from 0.125%. So 0.125% to 0.2%. The 0.125% was before Israel's surprise attack on Iran last week. There's also been an uptick in war insurance rates for the Red Sea, according to Marsh, while cover relating to ports in Israel has more than tripled to 0.7%. Israel and Iran are continuing to exchange fresh air attacks over recent days, including into the main cities of Tel Aviv and Tehran. Marsh McLennan told CNBC that given the situation is currently contained within the region, risks are still being placed to enable cargo to flow through these areas. Computing oil prices. Oil prices rose on Thursday after Israel and Iran continued to exchange missile attacks overnight, and US President Donald Trump's stance on the conflict. It's not clear at this point whether the US will enter the war or not, kept investors on edge. Brent crude futures were up more than $1 to about $77.76 midday on Thursday, while West Texas Intermediate crude was up to about $76.40. Brent had hit its highest in nearly 5 months at $78.50 on June 13th when the attacks started. So there is still a healthy risk premium which is baked into the price as traders wait to see whether the next stage of the Israel-Iran conflict is a US strike or peace talks, according to an analyst with trading platform IG who spoke to Reuters. Goldman Sachs said on Wednesday that a geopolitical risk premium of about $10 a barrel is justified. So how is the market computing oil prices right now, given the knowns and the unknowns? I reached out to Vandana Hari, Singapore-based energy analyst and founder of Vanda Insights, and I began by asking her how she saw factors driving oil prices right now, and also whether she was seeing any variations within or across oil products.
So indeed, like this playing out the various scenarios is probably what is engaging oil market participants, traders, stakeholders the most at this point. The challenge there is that, first of all, the situation is in a massive flux. Headlines from Tehran, from Israel, from the US, leaders are blowing hot and cold, stances are changing or shifting quite dramatically in some cases. So the picture is also constantly changing, sometimes on a minute-to-minute basis. But within that context, I think what the market has done, and this is in the initial hours and days, now we are into the 7th day of the direct attacks between Israel and Iran, is to look at some of the worst case scenarios, because you want to sort of take a look at them first and then decide what probability you want to assign to them, in the sense, should you be prepared for the worst possible supply disruption. So amongst the worst case scenarios, probably the most discussed has been a blockade of the Strait of Hormuz, because Iran has periodically threatened to do that whenever tensions have risen historically, but it has never actually done it. My personal view on this is that it's a near impossibility, or highly improbable, should I say, because just with one stroke, Iran would be turning the entire world against it. Definitely all its neighboring countries, which will not be able to send their oil across to the global markets, and all the consuming countries as well. So it'll make a lot of enemies in one go. Some of the other worst case scenarios the market has also looked at and discarded for the time being is a regional oil facilities getting hit, either deliberately by, I can't see why Israel would do it, but perhaps by Iran as some sort of a retaliation, or accidentally getting hit. Now, accidentally getting hit is really impossible for anybody to predict, but deliberately, I think that also the probability has been set aside. So as of now, what you see in crude, as you were mentioning earlier, crude has jumped, there's about, I would say, give or take $10 per barrel premium in Brent at $76 today, the premium on account of this geopolitical risk. But otherwise, what prices tell you, and this $10 premium tells you, is that the market is not accounting for any of the worst case scenarios in terms of a severe supply disruption.
Right. And if you look at, let's say, Iran as a producer, what is its contribution currently? And let's say if Iran were not to be able to produce and distribute the oil that it's currently producing, what happens then?
Yes, so Iran produces about 3.3 million barrels per day. It's been quite steady over the past several months. Its exports are about a little over half of that. The vast majority of its exports go to China. This has been quite a stable number. The question, what happens to the market if and only if Iranian oil production and supply is somehow disrupted, is, I would say, really not much. Perhaps you would get an incremental jump in crude as a knee-jerk reaction, but the wider OPEC Plus has way more than that amount of spare capacity, so it could easily step in. But as of now, amongst the scenarios, because Israel has not hit Iranian oil facilities to any substantial degree, So as of now, the scenario is not Iranian oil production getting disrupted either.
Right. So from what I'm taking away, the $10 jump that we have seen is really the geopolitical risk premium that is being factored into oil. And we are not really seeing any other factors play in, which sort of leads me to the question, until now, we were looking at some sort of demand compression and supply increase. And you refer to that as well. So are those factors still weighing on prices, or is that something that the market is not looking at right now?
Yes, one of the reasons you could say that crude has not jumped much more is that we have this crisis erupted in a background of a very subdued, almost pessimistic outlook for global economic growth, global oil demand growth, and on the other hand, a surplus supply expectations, especially so after about 3 months ago, OPEC Plus decided to accelerate the 2.2 million barrels per day that they were bringing back into the market. Initially, they had decided to do it very, very gradually, well into 2026. September is when the 2.2 would have been returned. So they were being very, very cautious. But something has dramatically shifted within the internal dynamics of OPEC Plus, and these 8 members are bringing back at quite a rapid clip this 2.2 million barrels per day. So yes, overall, the picture, which will endure once the dust has settled on this Iran-Israel crisis, is one of amply supplied market and a rather sluggish oil demand growth.
Right. Last question, Vandana. So within or across oil products, for example, natural gas or specific refining products like diesel or petrol or aviation fuel, are there any trends that you're seeing there which are specific or slightly different?
So we have seen diesel show a bit of a bigger risk premium jump, especially benchmark diesel prices in Europe. Now, one of the infrastructures that did get targeted was an Israeli refinery in Haifa, Israel's biggest refinery, which has been completely shut down as of the last weekend. So there is an expectation now that Israel will also have to import more refined products. So overall, there's a little bit of a bigger bump in diesel prices in Europe. To some extent, that is filtering through to diesel cracks globally. But otherwise, I would say we haven't seen much turbulence or shifts in refining margins. One thing to keep in mind, refining margins were good when crude was languishing in the low 60s, mid 60s for Brent. Now, crude prices have gone up, but refiners won't necessarily be able to pass through all these costs into the fuel prices. Refiners' freight costs will also go up, at least for this period of time while this crisis is lingering. Insurance costs, especially for ships going into the Middle East, have also gone up. So that could bring some pressure on refining margins.
Right. Vandana, thank you so much for joining me.
Thank you very much, Govind.
And here's a message from a sponsor. Want smarter investing at your fingertips? With InvestingPro, get real-time market data, custom alerts, and global financial insights all in one place. Join 46 million users already making sharper decisions. Download InvestingPro today. More details in the link below. Global FDI is falling. Global foreign direct investment fell about 11% in calendar 24 to about $1.5 trillion, which made it the second consecutive year of double-digit contraction, while international project finance deals fell about 27%. Mint quoted the United Nations saying on Thursday, investment activity weakened sharply, particularly in major economies like China and India. The World Investment Report 2025 by the UN Conference on Trade and Development, that's UNCTAD, said, according to the report, after stripping out financial flows routed through European conduit economies, global FDI actually rose 4% last year. But overall, the report is a sober assessment of global investment trends, particularly in Asia or developing Asia, which remains the world's largest recipient. So FDI inflows into developing Asia fell 3% in 24, reflecting the growing uncertainty in cross-border capital flows, says the report. China saw one of the steepest drops, with inflows falling just under 30%. India saw a smaller 2% decline, though UNCTAD pointed out that an uptick in greenfield project announcements suggests that much of the new investment is yet to translate into actual flows. So this is linked to project announcements. The larger concern is that UNCTAD is still warning that the investment outlook for 2025 has turned sharply negative, citing persistent geopolitical tensions and economic headwinds. And this is something that we can see even in countries like India, where there's uncertainty about capacity expansion, given the fact that we don't know where the whole tariff battle or tariff talks in, let's say, the case of India, the United States, are going to land. Air India reaches out. So Air India has reached out to passengers and the public with a backgrounder on the ill-fated AI 171 from Ahmedabad to London, which crashed on the 12th of June, even as the airline announced a 15% reduction in international flights because of aircraft shortages starting today. The letter signed by Air India CEO Campbell Wilson says the aircraft was well maintained with its last major check in June 2023 and the next scheduled for December 2025. Its right engine, he says, was overhauled in March 2025 and the left engine was inspected in April 2025, so in recent months. Both the aircraft and engines were regularly monitored, showing no issues before the flight, he said. He also said that these were the facts as we know them today, and that's Air India, together with the entire aviation industry, awaits the official investigation report to understand more. He also reiterated that the flight was led by Captain Sumit Sabharwal, a highly experienced pilot and trainer with over 10,000 hours of flying wide-body aircraft, while First Officer Clive Kunder had about 3,400 hours of flying experience. Air India says that as directed by the Directorate General of Civil Aviation of the Government of India, on June 14th, they've been conducting thorough safety inspections of their 33 Boeing 787 aircraft. So far, inspections have been completed on 26 and have been cleared for service. The remaining are currently in planned maintenance and will have these additional checks done before being released into service. Following that review, the DGCA has told Air India that the Boeing 787 fleet and maintenance processes fully meet safety standards. But the airline also says that because of the time required to perform these enhanced safety checks, along with the application of extra caution, external factors like airspace closures in Iran and the Middle East, as well as nighttime restrictions at some international airports, along with the normal airline technical issues, all of this has led to higher than usual number of cancellations on their long-haul network in the last few days. Apologizing for these inconveniences, the airline CEO said they would continue enhanced pre-flight safety checks on their 787 fleet and, as an added measure, on the Boeing 777 aircraft for the time being. The fact that all of this will take time and will affect schedules, Air India is reducing its wide-body flights by about 15%. This is international flights starting June 20th. That's today, at least till the mid of July. So that looks like about 3 weeks. This will also allow, says Air India, to have more backup aircraft ready to handle any unexpected issues. Wilson said that passengers would be offered rebooking for all of this on another flight at no extra cost or a full refund, and that they would share the updated international schedule within the next few days. And to reach out, that's passengers should reach out to them through their helplines for any questions or assistance. Meanwhile, Tata Sons chairman N. Chandrasekaran on Thursday skipped the annual general meeting of Tata Consultancy Services, marking his absence from a shareholder gathering of a group company for the second consecutive day, the Economic Times said. TCS company secretary informed shareholders of TCS that the chairman, that's N. Chandrasekaran, would not be able to attend the AGM due to some exigencies. He could not also attend the Tata Consumer Products AGM on Wednesday, reportedly because of his focus on the air crash on the 12th of June, which resulted or has resulted so far in the loss of at least 270 people, including 241 passengers and crew. Foldable phones are in. Samsung will unveil a thinner version of its flagship foldable smartphone at a launch likely to happen next month as it battles Chinese rivals to deliver the slimmest devices to the market, according to reported the CNBC. Folding phones, which have a single screen that can fold in half, became popular when Samsung first launched this device in 2019. It did look like that particular format would not really take off, but eventually it did, and it has. And also Chinese players like Honor and Oppo have since aggressively released foldables that are thinner and lighter than Samsung's offerings, says that CNBC report. An analyst at CCS Insight told CNBC that with foldables, thinness has become more critical than ever because people aren't prepared to accept the compromise for a thicker and heavier phone to get the real estate that a folding phone can deliver. And before we go for the week, a quick update. I will be traveling next week for a conference, and therefore my reports will be either short or intermittent and will only resume in full force the week after that. But we will be there almost on all days. But like I said, it will be either short or intermittent. And so feedback before we go. Manoj Kumar says, thank you, Team Core, for educating us about Reserve Bank of India's core inflation calculation anomaly. Agree with the report during a major geopolitical event and Trump tariff tantrums. Gold price movements will be erratic. It'll be better if we exclude that from the basket. Hassan Khan says, we've only got love for you, thankful, but sir, don't you think our market is valued almost correctly, or do you believe it is touching new highs by the end of the year? Would love your thoughts. Well, I'm not too sure, Hassan, but most analysts do believe that markets are very tightly valued, which means they are on the upper end of the valuation spectrum. But within that is, for example, small caps and mid caps, that there are more opportunities even at this time. But yes, the overall belief, including by large institutional investors, is that India's markets are fairly tightly or even richly valued. And then Agnostic Soul says, thank you for such videos. So thank you all for reaching out and your careful and thought through comments, which obviously, as always, help us in the way we decide our programming lineup and the kind of stories we pursue. Have a great weekend. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.